Hey, good morning, everybody. Welcome to another BloodHound Friday training workshop. Wouter has a question about Raven taking multiple trades. All right, so let's see. I'll use, so in Wouter's example, so he's using a moving average, and let's see. I just want to read this correctly. So he basically has a system that's trading whenever a moving average kind of changes direction. So Wouter, I take it you're probably just using a slope solver of some sort. All right, I think that's good for the chart. So let's get BloodHound open. And let's put in today's name. Oh, it's amazing this month is already half over. And all right, so we got today's BloodHound file name in there. And I will just start working on the logic board here. All right, so again, the goal of Wouter's question is Raven's taking multiple trades in the same direction, and he wants just the first trade he wants Raven to take just the first trade and not the second and third that might happen. So, and this will make sense here in just a moment once we get something built here in BloodHound. Let's see. So, let's see. Let's give this a name here. First trade of MA. All right, of the moving average direction change. There. All right. Nice long name there. Okay, so yeah, Wouter confirmed he's using a slope solver like this. So let's connect the slope solver in, and the red line on my chart is an EMA 55. So I'll just use that as the example. All right, so we're going to replace our SMA with an EMA. There's our EMA right there. I'll add it down there, and we'll change the period to 55 so it matches my chart. All right, so here's the deal. All right, so let's start off right there, for example. Stretch this out a little bit. All right, so I'll take this off as well. All right, so our EMA, right, it's starting to slope up, and so we get a long signal. And Wouter has said that I guess he's just kind of scalping here, and he's like scalping for 6 ticks. So so my box there is about 6 ticks high, and so he kind of gets in the trade somewhere around here at the bottom of the box, and he gets out at the top of the box, and so he gets in and out of a trade like within 2 bars, maybe 3 bars. It depends on what type of bar type he's trading. If he's trading a Renko bar, maybe it takes a few more bars, something like that. But basically he gets in and out fairly quickly. And then what happens is, you can see there's another long signal here, so that would throw him right into another trade, right? Because look, we have all of these long signals, so that's going to tell Raven to keep trading, right? As soon as the trade is exited, then on the next bar, well, there's another. Let's grab an arrow here, right? On the next bar, there's another long signal, and that's going to tell Raven, okay, take another long trade. As long as there is a signal from BloodHound, that's going to keep telling Raven to keep taking a trade. So what we need to do is essentially, I'm going to change my box here. Do something like that. So essentially, all these long signals here that I have covered up with my rectangle, we want to block all of those trade signals, right? So that way Raven isn't told to keep trading. All right. So that's pretty simple to do. There's two ways we can do this. So either you can take your slope solver here. So say for example, if Woodder is using some kind of a flat slope detection, right? Something like that. Then if that's the case, if he's using some kind of a minimum slope like this, right, we can see that it's changing the bar where we'd get into the trade. All right, so actually instead of getting in the bar on this trade, we would actually get into the trade on this bar. So here I'll just mark it. So remember, this bar used to be a green long signal, but since we put some kind of a minimum slope in there, it shifted it over to the next bar. And so now we want to block these long signals here. And the easiest way to do this is to grab a function node, and we're going to use a signal blocker like that. And let's plug that in. Roll that over. So now let's take a look at the signal blocker. And the first thing we need to do is figure out how many bars do we need to block this signal for. Right now it's only set to 5, but we probably need to block more than 5. So let's knock it up to 50 and see what happens here. So I'm going to shrink my chart up. Let's see if 50 is enough. And so it doesn't look like 50 is enough, right? Because I have a long signal here, and then I get another long signal. So that may not be desirable. So I might need to increase the number of bars that we're blocking a signal for. And oh yeah, see, here's another good example. So we get our first short signal, and then we get another short signal, basically 50 bars later, and then we get another short signal, another 50 bars later. Right, so we need more than 50 bars in there. So let's go back here, and actually looking at this stretch, that's at least 100 bars. So you kind of have to do a little bit of testing and to figure out what this number should be. You don't want to just set it up super high like that. It's not a good idea, because that takes a lot of extra processing that has to be done, unnecessary processing that has to be done when you crank that number up like that. So you do want to keep this number down to a minimum, to minimize the amount of processing that has to be done. But at the same time, you don't want to set it too short and accidentally get into an extra trade there. So let's try something like 125 bars. See if that helps. And oh, look, still not quite enough. So all right, let's just bump it up to 200. And okay, there we go. So that kind of fixed that area there. I'm going to shrink the chart down even more. And so what we're looking for is basically alternating long and short signals. Alternating long and short signals. And so far, so good. Now, of course, the number of bars that you need to block for, is going to definitely depend on your chart type. So, and it's going to depend on how fast of a time frame your chart type is as well. So I think so far 200 looks good. So we'll just kind of go with 200. We'll just say that was good. So anyways, that's all we had to do, was just throw a signal blocker in there like that. So and then just scan through the chart and see how many bars we need to block for, right? So of course, another factor is going to be what type of moving average you're using, right? If you're using a slower moving average, then you might have to block for more bars. So there's a lot of variables involved, but you guys should get the concept here. Just throw a signal blocker in there, and just kind of slowly increase the number of bars that you're blocking for, until their signals look good. So, all right, now there's another way that we can do this as well. So, if you're using a maximum slope, to kind of filter out flat areas within your moving average, then you're going to want to use this design right here with a signal blocker, right? A slope solver and a signal blocker. So however, if you're not using a maximum slope like that, then we could use the inflection solver. So let's plug that in here. And let's give this a name, EMA 55 inflection. And we'll change our indicator over to the EMA like that. Let's change the period to 55. And there we go. And we can see, let me stretch this chart out again. And essentially the inflection solver marks just the first bar when your indicator changes direction, right? Whenever your indicator reverses direction, the inflection solver just marks the first bar, of that reversal point, like that. So the inflection solver could be a lot simpler to do. But the difference is that you can see the inflection solver, it doesn't have a minimum slope kind of filter, right? Because the inflection solver is not looking for any kind of slope, it's just looking for that reversal point of the slope. So it doesn't have any kind of minimum or maximum slope parameters like the slope solver does. So there's your two options there, Wouter. And so your goal is, your goal is just to get, right, just the first signal like that, and then there's no more short signals afterwards. So therefore, Raven will no longer take any more trades. So that's all that's needed. Okay, great. Good starting question there. And so let me just take a look at the board and see what kind of comments we have here. Good, yeah, I think I took care of it. So, and let me just kind of throw this in here just to kind of get into some kind of advanced stuff. Let me set the chart up here. Actually, let me just kind of show you here. Right, since right? Since I'm using the slope solver and I put in kind of this I set a maximum and minimum slope here, right? So we notice that we kind of get some, right? We get some areas here that are filtered out. So these are kind of basically where the moving average is just too flat, and so we're not getting any output from the solver, right? So we only get an output when the moving average has a minimum kind of a slope here. So right, so any slope greater than 0.25 ticks, that's the only time we get an output. So that kind of eliminates these flat areas here like this. And let me mark the other one. Kind of mark these flat areas like this. So let's kind of shrink this, and here I'll mark this bar there. Let's mark that bar. And actually I'll mark this bar again as well. All right, so let's take a look at the chart here. So you notice with the signal blocker, right, we got the first long signal, and then there's not going to be, there will be no more long signals until we get a short signal, right? So we must get a short signal first before we can get another long signal, right? So this signal blocker is basically, it's going to keep flip-flopping. It's going to block signals until we flip-flop, right? You can see it's going from long to short to long. So you'll never get two longs in a row. But let's say, for example, maybe you did want to get another long signal, because like right here, we can see the moving average. Basically, we had a pullback from price, and so our moving average rolled over and then rolled back up again. So say like if this condition right in here was like a reset, right? So the moving average didn't roll over enough to take a short, but it did roll over, it flattened out enough that maybe you might want to re-enter into another long trade. Well, we can do that by taking this inflection solver. So remember, this inflection solver, right, it did generate a short signal there when the moving average rolled over. All right, and then we got another long signal, right? Another long signal when the moving average rolled back up again. So let's say we kind of wanted to. So let's say we wanted to allow this second long signal here. So what we could do is take this inflection solver. Right, let me connect up the signal blocker. You can take this inflection solver and plug it into the reset like that. Now we didn't have to change. You can see we got the long signal there. So, and we didn't even have to change any of the resets. Just the default resets is all that we're using. The only thing that we had to change was just, the number of bars that we're blocking signals for. And so now we kind of built a system that allows for a secondary, or well, not secondary, but another entry, as long as we kind of get, as long as the moving average rolls over a little bit like that. And then that moving average rolling over, we're using that condition to reset our signal blocker and allow this second signal to come in. So there you go, just a little advanced tip there, but we'll just disconnect it like that. So we'll just leave it like in its original state like that. So all right, so there we go. I'll leave you with that. Will's question is basically like the same as what I've got here. So when the slope changes direction, that is our entry trigger, and then a crossover condition would be the exit logic. All right. So, all right, so yeah, so will, it's going to be an exit logic, not a stop. So, all right, so let me get that other moving average back on the chart here. And all right, so let me clear all these drawing tools. All right, so like right somewhere around right here would be the entry point when, so I'm just going to use these EMA and SMA over again. So we'll use the EMA 55 as our entry, or as our moving average indicator for the entry. And so our entry is going to be, I think, right here where this arrow is. And the exit would be on this crossover there. All right, so we gotta, so when these two moving averages cross each other, yeah, it's a moving average crossover. So that would be the exit. So let's see. I'll just put a diamond up there for the exit. So that would be the exit. So, all right, so let's get BloodHound back open. So we've already got like this inflection. I'll just use the inflection this time for the entry example. And let's see. Well, it just doesn't make logical sense because, you know, we've got all these other, you know, so we've got a long signal there, but then we have a short signal there, you know, so you'd be in a short position way before you actually got exited out. So that's kind of why I need the detailed information here. I'm just kind of, you know, grasping at stuff. All right, well, even though this doesn't make sense, I guess still the exit logic that Will is looking for is still going to be the same. He's just looking for, you know, an exit signal when we get a moving average crossover. So just simply put, we're going to make a new logic template, and all right, so I'll just call it something like this, right? So exit at a moving average crossover. So, all right, just a moment. I'm just going to read some comments here. Okay, yeah, so we're just going to grab a crossover solver like that. And so in my example, we have the SMA 14 crossing over the EMA 55 as our exit, right? And sometimes I like to just put the word exit in the name as well, just so that way I'm not confusing this solver with possibly another crossover solver that's used for the entry or something like that. And there might be some subtle differences. All right, so we've already got the SMA 14 here in input A. So all I need to do is change my input B. I just need to change this to the EMA 55. All right, let's go find that. And like that. All right, and here we go. So we can see we have this, right, a a short signal for a long trade. So, right, so we had a long signal here for a long trade. And so you want a short signal as your exit to exit a long trade. So this short signal here, if it's used as an exit, it will exit a long trade, right? So it's not going to generate a short trade. It's only going to generate an exit if you use it as an exit. Right? So now that we've got, we kind of have an entry logic template and a exit logic template. So now all that we would need to do is go into our strategy. Right, and that's it. I'll just use Raven for an example. Right, so it's the same concept in BlackBird. You'll just load up your template. Right, so let's load the template. There's today's file. Load it up, click OK, and in both Raven and in BlackBird there's a entry logic and there's a exit logic. So we would select our entry logic, and then we would select our exit logic like that. And that's it. That's all there is to it. It's that simple. So again, Patrick's question is about generating a signal when there's a gap between the close of one bar and the open price of the next bar. So let's use daily bars. That'll make it a lot easier for us to do. And okay, great. Yep, there's all kinds of gaps now. Yeah, all right, good. Okay, so what we're going to use is the comparison solver for that. All right, so let me make a new logic template. Okay, so all right, so we're doing some gap hunting here. And let's grab a comparison solver. And so when us as humans, when we look for gaps, right, simply put, here we go. Here's a great example. So wait. Here we go. So there's the close of one bar, right? The close of one bar, and then there's the open of the next bar, right? So we can visually see this distance between the two lines there, right? So that's simply what we're looking for, right? And so we're looking at the close of one bar. Let's stretch this out here, right? So we're looking at the closing price of the previous bar and comparing it to the open price of the next bar, right? To generate that kind of gap, that gap price. So we're going to use a comparison, and we're going to compare the open. So we're going to compare the open of the previous bar to, we're going to compare the close of the previous bar to the open of the current bar. All right, so we'll do a comparison here. And let's see. All right, so the open of the previous bar to, sorry, I keep getting those reversed here. The close of the previous bar to the open of current bar. All right, so we're comparing prices here. So we're going to set our type here, change it from an indicator value, and we want to change it to price, right? Because we're comparing one price of one bar to the price of another bar. So we're going to set both of these to price. All right, so there we go. So input A, right? It's already, so you can see that the price is default to the closing price. So we're already good. They're defaulted to the closing price. Now we want to look at the previous bar. So we need to change our look back period to 2 because we want to look one bar back, an extra bar back. That's all we have to do is change it to 2. So this look back processing, we want to leave it on single value. All right, we're going to leave it on single value. And then next, so really all we had to do is just change this to price and change our look back period to 2. That's all we had to do. And all the rest we just use the default settings there. Now down here in input B, we need to change the close price to the open price because remember we're comparing yesterday's close to today's open price. So we're going to do something like that. And yep, there we go. Okay, and that's that. So, yeah, that's it. So, and if, okay, oh, I'm sorry. So here's another thing. So Patrick wanted to look for like a certain, a certain size gap. So let's see, we're on oil, I believe. All right. Let's look for a 50-cent gap in oil. Something like that. There we go. And let's take a look here what we got. Yeah. So there we go. There's some extreme gaps. And so you can see this gap up actually generated a short signal. So if you're fading the gap, there you go. You got your short signal to fade that gap, right? If you're not fading the gap, then what we could do is just simply reverse the outputs here. That's one of the things that makes the comparison solver such a great solver is you can easily just kind of reverse your outputs like this. All right, so all I had to do is just reverse my long output and reverse my short output, and then I just generated a long signal for a gap up, like so. Right. So I will put this back to the default settings. There. So this is the default comparison solver settings right here, or the default settings for the outputs, I should say. And so there we go. All right, so I'll just run through this again here. So input A is looking at the previous bar, right? So we're taking the close of the previous bar. So that would be this price right here. So this would be A. This arrow here would be A, input A. So this is right yesterday's closing price of that bar, and then we're comparing it to the open of the current bar. And so input B would be the open price, and we just leave the look back period at 1. So a look back period of 1 is the current bar. And so that would be this price for this arrow right there. So there's the open of that bar. So, interesting. Okay, so the high of the bar must be equal or greater than the upper Bollinger Band, and then the next bar must be a gap down. Okay, so we're going to switch to intraday. Yeah, we're going to switch to an intraday to do this here. All right, so let's kind of get the chart set up in preparation for this. All right, so let's switch to a minute chart, I guess. And let's get our Bollinger Band on here. And I don't know, any particular deviation, standard deviation we should be using. I'm not sure if 1 is good enough. Yeah, I guess so. Yeah, 1 ought to generate a lot of signals for us to test with. So, so I'm actually going to scan the chart right now and see if I can find an example here first. And well, actually no. Actually, this is going to be a little more difficult than I thought, just manually looking. So let's let BloodHound do some hunting for us. All right, that's the beauty of BloodHound, is it can identify stuff so much faster for us. All right, so let me, I'm actually just gonna, I'll just start with a new logic template here. And new, all right, so all right, so there we go. So Bollinger break with a gap. All right. Okay. Let's see, 10-10, huh? All right. Yeah, there we go. So, okay, yeah, so we have a 1 tick. Yep, a 1 tick. Just a 1 tick gap down. All right. Then that right there also would be another one. Yep. So there we go. A 1 tick gap right there. Yep. All right. So I'm going to make a copy of this solver here. And all right, so this was kind of set up for a daily chart, so I'll just rename that. And all right, so this would be more for an intraday, because we're just going to look for a 1 tick gap. So actually, let's just, since we're dealing with oil, I'd recommend you do something like this. Right, oil, well, yeah, since I'm dealing with an oil chart, oil is notorious for trading on tenths of a tick or even hundredths of a tick. So I don't know why they allow that in oil, but I see that coming through all the time in dealing with oil. So I'm actually going to set it just slightly under a tick. So that way if our gap is like 0.99 of a tick gap, this will cover that, just because of all the non-tick prices that come in, or the splitting of a tick prices that come in on oil. So I'm just gonna, so you can always, so when you're looking for, separations like this, just be aware that you can always do something like this. You can always put, a half of a tick, or 0.9 of a tick or something like that, just so you don't miss a signal, because price came in, slightly less than a tick difference. So yeah. All right, so we're gonna do that, and all right, so that one's set up. So let's get that copied onto the board now. Here we go. Let's plug that in and let's take a look. All right, let's zoom in here. Okay, so you notice that, so I'm gonna assume that we're looking for a short trade, like right here. Right, probably looking for a short trade there and a long trade there. And so you can see my signals are backwards. So we're going to reverse the outputs here. Set that to 0, set that to 1, set that to 1, and set that to 0. So there we go. I just reversed my outputs. So now I have, an output in the correct direction like that. All right, so my gap is done. So now we need to do the first part, which is look for that Bollinger break. So what we're looking at is the high of the bar. So all we need is the high of the bar to break, or the low of the bar to break. Right, that's all we need. So those are the two price points that we're going to look at. It's the high of the bar and the low of the bar here. Okay, in just a sec, I'm going to clean up the board here. Clean up my question board. Okay, there we go. Okay, yeah, so once again, we're doing a comparison. We are, checking the Bollinger Band, and we're comparing the Bollinger Band to the high of the bar, or we're going to be comparing the Bollinger Band to the low of the bar, like that, right? We're checking for that separation there. So that's going to be another comparison solver. Right? We're comparing the high of the bar to the upper Bollinger, or the low of the bar to the lower Bollinger. So let's connect up this comparison solver, and we'll get this comparison solver working first. So let's see. All right, so we're looking at the high or the low. We're checking to see if it's above or below. Right, the Bollinger bands. Okay, so we've got some kind of name in there. So, all right, so the first thing we're looking at is price. So let's set input A to price. And, all right, so for a long signal, right, so for price type long, that's for a long signal. So let's come over here to our long signal. And so for the long signal, we're using the low price, right? We're comparing our low price here. So let's set price type long to the low price. There we go. And then the price type short, well, that's typically going to be the opposite. So that would be the high price in this case. All right, so there's our prices set up. All right, now input B, we need to set that up to our Bollinger. So let's go in here. Let's go find the Bollinger. Here we go, add it to the board. And let's see here. So, okay, on my chart, I actually have a standard deviation of 1. So we'll set that to 1, and I'm pretty sure the period is 14. Let's see, Bollinger, yes, 1 and 14. Okay, so there we go. Make sure you get your parameters set correctly. All right, now we need to figure out what plots do we select. So let's slide this out of the way here. Okay, so we're using the upper band. Let's take a look at our example over here on the chart. So the upper band we're actually using to generate a short signal here. So remember, I got my arrow marking that this is actually for a short signal. So we're using the upper band for a short signal. And so that means we're going to be using the lower band for a long signal. So we're using the lower band for a long signal. So there we go. Long signal, short signal. Click OK. And next, excuse me. Next, we need to figure out our outputs here. And yeah, we do need to reverse our outputs because remember, the reason why we have to reverse our outputs is we are building kind of a reversal trade signal, right? So this trade signal is not with the trend, it's kind of a counter trend, right? So if you're building a counter trend signal, basically we're looking for failures after breaking out of the Bollinger Bands. So that's a counter trend signal. So typically when you're building counter trend, then what you need to do is reverse your outputs. So remember this other comparison solver, we had to reverse our outputs because once again we're looking at a counter trend. And so it makes sense that this comparison solver, we also need to reverse the outputs here. Use the opposite outputs like that. Okay. Now this makes a lot more sense. So if we look here, right, the highs of these two bars are just are above the upper band, right? They broke above the upper band. And then we got a low of this bar that broke below the lower band. And then over here we can see we have a bunch of lows from these candles that are below the lower band. And once again, there we go. We have two bars here where the high is just barely above the upper band, right? So there we go. And then bars that are inside both bands, and we get no output, right? Okay, so there we go. We got that. And okay, so now there's one last thing we have to do. Okay, yeah, I'm going to pull your attention here. Let's take a look at this. Oops. All right, that also qualifies as a signal. So we have a 1 tick difference between the close and the open of the next bar, right? So, yeah, so we can see we've got a long output here. So we do have a long output from this gap. Let's let's draw this arrow here, right? So we do have that gap there, that one tick gap. Right, so this is our solver that's finding the gaps for us. Now, let's take a look at the other solver that's finding the Bollinger breakouts. And so you notice that actually the Bollinger breakout is on this bar, but the gap is on the next bar, right? So there's a difference here. And so if we just threw these into a AND node, right, we're completely missing the signal here, right? The signal is completely missing. And that's because these two solvers are giving us an output on different bars, right? So we had a long over here, and the other solver gives us a long over here. So what we need to do is this solver that's finding the breakout, so the breakout happens first, and then the gap happens second. So we need to take this long signal and shift it over to the next bar where the gap occurs. Okay. So what we're going to do, so to do that, we can use a lookback node here. So plug this into the lookback, and on the lookback we want to use this displacement of 1. So it's already displaced by 1 by default, so we don't have to change any settings, but this is what we want to use, is we want to use this displacement right here. That's what we're looking to use. So I'll disconnect that from the AND node, and let's take a look at the lookback. So now you can see the signal shifted over. So let's take a look at this solver itself. So here's the solver. There's its output on that bar. And with the lookback, the output got shifted over to the next bar. And the next bar is where our gap signal is at, right? So now once we take the lookback, plug it in there, and there we go. Now we get our signal here. All right, so that's it. Let's clear all that out. And so that's our condition right there. Something else that we could do. So let's just say that our one tick gap is good enough. So let's put that back. And let's say we wanted to make sure that we had kind of a significant breakout, that the high of the bar needed to break out away from the Bollinger bands, with a pretty good breakout. So let's see, let's do something advanced here. We'll use volatility. So I'm going to change this to ATRs. And let's see, I'll kind of knock the volatility down a little bit. I'll just knock it down to 20, I guess. 20. And then let's see if we can get at least like half a bar of a breakout. Right, so what we're doing, what I did is I changed the distance between the band and the price of the bar. Right, so you can set a kind of minimum distance between the band and the bar price. And if you use ATRs, well then that's going to use like an averaged volatility to measure that distance. So if price is really volatile, then you might want to wait for price to break out even a little more. So, so I set this to 0.5 ATRs. Right, so that's only half a bar of a breakout. Let's say we want 3/4 of a bar breakout. See what happens there. There we go. It definitely reduces the number of signals that we get. So anyway, so there's a couple of settings that you can play around with. So let's say we really want an extreme kind of a breakout there. So 1.5 bars, right? 1.5 ATRs would be 1.5 bars. Now we can see that, right, price has to break out a little bit more before we can get any signals, right? In other words, price has to pull away from the bar quite a bit more. Right, so now we need this longer distance away from the band. Right. So there's a couple of measurements that you can play around with. All right, so when we're comparing price to the Bollinger, right, you would change this distance or this different settings here to require price to break outside the bands further. And if you wanted to change the gap distance, then you would just take a look at the other solver down here that's measuring the gap, right? So the close of the previous bar to the open of the current bar. There you go, a couple of settings you can play around with. So, all right, I'm just going to put that back, restore that back to its default to ticks. There we go. Let's see, all right, yeah, Patrick is asking, what if we get a bar that spans across both bands? So here we go, perfect example, right? We got a bar here that is the highs above the upper band and the lows below the lower band. And so I guess it depends on the direction of the bar because, let's see. Yeah, so then it would fall back to the direction of the gap, right? So let's, here we go. So if we look at the solver, so here's the solver, right, that's looking for price breaking out of the bands. And so look, we get both a long and a short output at the same time, right? That solver gives us a long and a short. So that's telling us that we're set up, right? So basically, this bar has set up for both a long signal or a short signal because it's broken out of both bands. So then the next determining factor is, well, where is the gap? Is it a gap down or is it a gap up? And that, of course, that will determine the direction of the trade. And so if we look at our gap solver, well, there was no gap. So, yeah, no gap, so no signal there. But let's see if we got another one here. Oh, here we go. All right, we have 3 other bars here. So 3 other bars that are breaking out of both bands. And so let's take a look at the final results. And so we got a gap down. And yes, we got a gap down here. There we go. So since we had a gap down, we got a short signal out of it. So there you go. So you might need to add some additional filtering to this. So we maybe just adding a bar direction might be appropriate. However, a bar direction at the same time might eliminate some signals. Let's see here. Yes. So we do, if you use a bar direction, you're gonna get some dojis filtered out. So, right, so there we go. So we got a doji right there, and if we add a bar direction, yeah, it filtered out that doji. Oh, well, it filtered out that one as well. Interesting. So, I don't know. Maybe a bar direction is the right thing to apply. All right. Yeah. Just so you guys understand what's going on here. So when I take this bar direction, right, as you guys know, there's two components here. So let me kind of find an example here. Okay. I found my example. All right, so here's our gap. Right, that's our gap. So we got that bar below the Bollinger, and there's our gap. And so therefore, here's our signal. Right. So this is our trade signal. Okay, so if I just throw in a bar direction, right, the bar direction applies, to the gapping bar, right? It applies to the gapping bar. That bar direction does not apply to the breakout bar. It only applies to the gapping bar. So if you want the bar direction to apply to the gapping bar, so let's say, let's see, yeah, I'm not sure if this is going to make sense. Yeah, because, all right, since this is a reversal, kind of a counter trend system, right, normally the gapping bar is going to be a down bar, right? But oddly enough, this signal actually came from an up bar. Interesting. So, okay. Well, anyways, just to kind of illustrate my point here. So if we wanted to apply the bar direction to the gapping bar, or the breakout bar, then what we need to do is take this bar direction, and we can use the start bar as a go, and we can set that to 1, and so that basically kind of starts back 1 bar. And so now the bar direction is actually looking at the breakout bar. And so that's probably going to eliminate a ton of signals here. Let's see here. Yeah. So the bar direction is acting on this breakout bar because it's a down bar for a down signal, right? It's a down bar for a short signal. So, but let's say, you know, we for a short signal, let's say that we actually wanted an up bar, right? We want an up bar for this short signal. Then let's see what we need. Is a function node. So we need this long short modifier. And the long short modifier, its default mode is swap. So it's going to be, so what its default mode is it's going to be reversing the longs for shorts. Like this. So let's take a look here. Right, so you see all these down bars, right? All these, oops, hold on a sec. I need to set my start bars to go back to 0. There we go. So you see all these down bars, right? Those are all down bars, but we can see that we're actually getting a long signal coming from the bar direction now, right? So we've reversed the signal. So in other words, when we get this up bar right here, this up bar has actually been reversed to a short, right, to work with this short gap down there. So there's lots of ways we can play this. Plug that in. And then remember, I need to, so since I want my bar direction to be on the breakout bar, then I'm going to use the start bars ago. Set that to 1. So the start bars ago does the exact same thing as this displacement does on the look back here. All right, so this look back has a displacement. Well, the bar direction doesn't have a displacement. It has a start bars ago. It's, you know, it's a subtle technicality. That's why it has a different name. But yeah, they are subtly different. So that's why they're different names. So that's why the bar direction isn't called displacement, because it is a subtle technical difference. But all right, so let's take a look now. There we go. Yeah, so there we go. So the breakout bar is a down bar, so we can get this long gap up signal. And same over here. These are all up bars, which gives us, you know, so we have to have an up bar to get the gap down. So, all right, so that's two different ways that you can do that. So we could plug that in, or let's see, we could just add another bar direction like that. So either way, there's two ways of doing that, or two ways of looking at this, right? Yeah, two ways of looking at it. So, all right, so with just a simple bar direction connected in here, then that just requires the gapping bar to be in the direction of the signal. So you can see that all the signals match the direction of the bar. So these are two down bars, and so those are short signals. This is an up bar, and so we get a long signal there. All right, well guys, cool. With that, we'll wrap it up, And so have a great weekend, and I hope to see you guys next week. Okay, guys. Bye-bye.